Calculate and interpret the cost of equity capital using the capital asset pricing model approach, the dividend discount model approach, and the bond yield plus risk premium approach. Now, as you might have guessed from the LOS, we have three methods to estimate the return common equity holders will require: the capital asset pricing model, the dividend discount model, and the bond yield plus risk premium approach. The first method we're going to look at is the capital asset pricing model, the CAPM. The idea here is that we are going to adjust the market's risk-free return to account for the relative risk level of this company. Using the risk-free rate as a starting point, we add a premium based on the specific company's risk level, which we estimate using the company's beta. The formula for the required return on an equity investment using the CAPM is given as risk-free rate plus beta times the return on the general market minus the risk-free rate. This portion here is referred to as the equity risk premium, the premium in return that we get for investing in this company, accounting for the fact that the risk-free rate would be default risk-free and this equity investment is not. Given a market risk-free rate and the expected market return, we can clearly see the difference in return between a risky company and a less risky company. For example, given a market risk-free rate of 3.4% and an expected market return of 7.3%, we could look at two companies side by side. One is higher risk, so its beta is, for example, 1.7. The other is risky, but to a much lesser degree than the first, with a beta of, say, 1.1. Okay, now we move on to the dividend discount model. The idea here is that the price of an equity security can be deduced from that security's expected dividends going forward. If we can estimate the next upcoming dividend and we assume a constant growth rate for the dividend, the relationship between the market price and the dividend can be used to estimate the required return. This is the relationship between price and the upcoming dividend. The R term here is the expected return on the company, and the G term is the expected constant dividend growth rate. Rearranging for the rate of return, we get this relationship, a new method for estimating the required rate of return on a stock, this time based on its dividend yield and the expected growth rate of its dividend. Now, in general, we will know the market price of a stock and we should be able to reliably estimate the company's expected upcoming dividend if it's not immediately available for us. The only thing we're really missing here is this expected constant growth rate. Where do we get that from? Well, there are two major ways of estimating this growth term. The first is to simply buy that information. There are a wide variety of information sources who offer company metrics for a fee, so we could go that way, or we could estimate it for ourselves. The key to estimating the growth rate is sustainability. How much can we sustainably pay out in dividends? For this, we use a relationship between the company's historical return on equity and its dividend payout ratio. This term here, 1 minus the dividend payout ratio, is often referred to as the retention rate, the amount of its earnings that a company does not pay out in a dividend. Finally, then we have the bond yield plus risk premium approach. This final approach is similar to the CAPM. With the CAPM, we started with the market risk-free rate and added a risk premium to account for default risk. Here, we start with the interest rate on the company's long-term debt and adjust for risk from there. This is the formula. We simply add together the yield on the company's long-term debt with a premium related to the difference in risk between the company's debt and equity, which is often assumed using the historical spread between debt and equity returns. Calculate and interpret the beta and cost of capital for a project. Beta is a measure of a company's risk, a measure of how much more or less risky this company is compared to the general market. Previously, we have built on a company's beta with the capital asset pricing model to estimate that company's cost of equity capital. Here, we're going to go back a step and estimate the beta for a particular project, which we will then use to find the cost of equity capital for that project, and from there we'll bring in the firm's capital structure to get an estimate of the overall cost of capital for the project. Now be careful here to realize that so far we have been talking about a company's beta, the risk of a company as compared to the general market. It's important to remember that a company's beta is based on both the average risk of the various projects it is involved in and the state of its capital structure. This throws up a couple of complications when it comes to estimating the beta of a specific project. To estimate the beta of a prospective project, we can use the pure play method. Here we look at comparable companies who are fully engaged in the kind of project we are looking at and adjust from there, where adjustments account for the difference between this comparable company's capital structure and our own. We need to unlever the beta estimate to remove the effect of their capital structure and relever it to account for our own capital structure. This unlevering and relevering process is performed using this relationship. You should memorize this formula. Let's take an example to get a sense of how to step through this process. Given the following information, calculate the firm's weighted average cost of capital. Company X has a target capital structure consisting of 65% debt, and they currently operate at their target capital structure. Their cost of debt capital maintains a spread of approximately 300 basis points from the risk-free rate, and their corporate tax rate is 27.5%. Some more general information then. The nominal risk-free rate, taken as the 20-year Treasury yield in the US, is 2.5%, and the long-term average equity risk premium is currently recorded at 6.2%. We are also given some market information on comparable companies. Here, company A, B, and C are shown including their debt-to-equity ratio, beta, and their corporate tax rate. Here are the steps we need to go through to get the answer. We start by taking the beta of the comparable companies and we unlever them. Step 2 is to calculate an average unlevered beta from this group. From there, we relever, accounting for company X's capital structure, and the last step then is to estimate the weighted average cost of capital using the formula we discussed earlier on. Okay, step 1, unlever. Step 1 is to take the information we have been given about the comparable companies and calculate unlevered betas for each. We have the data and the relevant formula, so it's just a case of plugging in and getting the 3 answers. Be careful if you are memorizing this formula which beta goes where. In this case, we are taking levered betas and converting them to unlevered, so we actually need to tweak this formula. I've done this in 2 steps, so you can see it, but you will not need to perform these 2 steps in the exam. Simply note down your 3 results and move on to the next step. Step 2 is simply to take these unlevered betas and calculate an average. In this case, I have used a simple arithmetic mean, but depending on the circumstances and the relative comparability of certain companies used, you might need a weighted average here. Step 3. Here we need to relever beta to account for company X's capital structure. Remember from the question that we are given company X's debt position in their capital structure. Given 65% debt, we can assume the remaining 35% is equity and infer their debt-to-equity ratio from there. So now we have the relevant information, and as before we know the formula, so again, we just need to plug in to get to the next step. Company X's levered beta equals the average unlevered beta of 0.64 times 1 plus 1 minus the 27.5% tax rate times the debt-to-equity ratio of 1.85. This gives us a levered beta of 1.487. The 4th step here is to use this beta to calculate the cost of equity. We calculate the cost of equity using the CAPM. We have the risk-free rate and the expected market rate from the question, and now we have beta. We simply plug into the formula 2.5% plus 1.487 times the 6.2% market risk premium. Be careful here. we are actually given the premium in the question rather than being given the expected return on the market to plug inside the bracket with the risk-free rate we saw before. Finally, then we take the information we have gathered for the last step to calculate the WACC. Weighted average cost of capital equals WEKE plus WDKD times 1 minus the tax rate. 35% times the 11.7% cost of equity, plus 65% times the cost of debt, 300 basis above the risk-free rate, times 1 minus the tax rate of 27.5%. Giving us a weighted average cost of capital of 6.69%. Describe uses of country risk premiums in estimating the cost of equity. So let me give you a little bit of background here. Up to now you have seen this formula here where we are taking the risk-free rate, a beta and a market risk premium to estimate required return. This LOS is based on the fact that when we are focused on a developed economy, the risk of the country where the project is located is pretty well priced into the company beta. When we look at developing nations though, this relationship is not as accurate. We fall short in terms of pricing in the sovereign risk of the country involved. And to that end, we need to factor in a country risk premium. Now there are two major approaches to estimating this country risk premium. The first is to just look at a country's sovereign yield spread, the gap between the rate paid on a hard currency bond issued by this local government and a comparable treasury security. The second approach we can use is a bit more complex, involving this sovereign yield spread and some measures of equity market volatility. Now it's a big ask to memorize the wording of this slide, so for simplicity, at the very least, you need to remember that above the line we have a developing country's equity volatility and below the line we have a developed country's bond volatility. From there, given the right data, it's just a case of plugging in and then applying this country risk premium in the right way to the CAPM. Explain and demonstrate the correct treatment of flotation costs. Flotation costs, or a flotation fee, is an amount charged by investment bankers for services provided in the issuance of capital. With debt and pref stock, the amount charged is generally very small, so it's often not factored into an analysis. But with the issuance of equity capital, it's a more significant cost, so we cannot ignore it. There are two ways we could potentially incorporate flotation costs into the analysis of a project. Option 1, we could include it as part of the cost of capital, adjusting the overall cost of capital to account for this practical cost of assessing this funding. Or, option 2, we could include this cost as a negative cash outflow at time 0, an extra amount to be accounted for with the project's initial outlay. This second method is more appropriate because the fee charged by the investment bank will come as an initial cash cost. It does not reflect reality to account for this cost by adjusting the present value of future cash flow amounts when this cost is a one-off payment occurring at a specific point in time.